At the Greenard Group, we take time to map out a placement plan for which investments will go in which accounts, and there are certain principles that we factor into our recommendations. An important note is that we do not duplicate holdings across your accounts. This is for several reasons, but one of the reasons is to help ensure that your portfolio is structured in the most tax-efficient manner. The Greenard Group follows 6 principles of placement for investments between registered and non-registered accounts. Here's the first principle. U.S. stocks that are primarily growth-oriented, meaning they have zero or low levels of dividends, may primarily be held in a non-registered account. Any returns generated will be tax-efficient capital gains. The second principle. Stocks that have a higher level of fluctuation and risk should generally be held in a non-registered account. Losses in a non-registered account can be offset against capital gains, and any unused net capital losses can be carried back up to 3 years or carried forward indefinitely. The term beta is a measure of a stock's volatility in relation to the volatility of the market as a whole. The market as a whole has a beta of 1. Stocks with a beta of less than 1 would be considered less volatile than the market. Stocks with a beta greater than 1 are considered more volatile than the market. Higher beta holdings should be primarily held in a non-registered account. The third principle. U.S. stocks that pay moderate to higher levels of dividends may be held in a registered retirement savings plan or registered retirement income fund. The convention between Canada and the United States was negotiated to ensure that double taxation does not occur on certain types of income. As a result, the U.S. does not withhold any tax on U.S. dividends or interest within registered retirement savings plans or registered retirement income fund accounts. Fourth principle. U.S. stocks that have a lower level of fluctuation and risk would generally be held in a registered account. Stocks that have a beta of less than 1 are generally less volatile than the market as a whole. Fifth principle. Canadian equities with returns from the growth in share price and dividends, for the most part, would be held in a non-registered account when possible. This is because only 50% of capital gains on the sale of shares appreciated are taxable, and the dividend distributions are eligible for the dividend tax credit. The sixth principle. Depending on your risk appetite, holding medium-risk blue-chip Canadian equities within a tax-free savings account may be right for you. The U.S. does not recognize tax-free savings accounts as a tax savings vehicle for Canadians, and as a result, a 30% withholding tax is applied on U.S. dividends unless the Canada-U.S. tax treaty reduced rate of 15% is applicable. This is an absolute cost that cannot be claimed or recovered. We always caution clients not to be too conservative with the tax-free savings account, as you'll not be able to utilize the true benefits of tax-free growth. On the flip side, we also caution clients not to be too aggressive with the tax-free savings account, as losses cannot be claimed as it is a registered account. If you like this video, you can discover more videos in the Greenard Exchange section of our website. You can also read past and current articles in the Greenard Index section. Thanks for listening.